Global technology infrastructure is currently experiencing a massive, capital-intensive investment cycle. Yet, the equity markets in India are seeing a historic extraction of liquidity. Since peaking in September 2024, the Indian market has seen $924 billion in value evaporate. Foreign institutional investors have withdrawn a net $42 billion over this period. This exodus has pushed foreign ownership of Indian equities to a 14-year low. This chart tracks the Nifty 50 against its North Asian peers. The Nifty declined 9% year-to-date, while Taiwan surged 42% and South Korea jumped 78%. Isolating this exact divergence point, it aligns precisely with the global AI hardware build-out. Institutional investors are not treating this as a standard cyclical macroeconomic dip. They are executing a structural repricing of the market's terminal value. Capital is rotating out of consumption-led markets and deploying directly into regions aligned with artificial intelligence infrastructure. This shift forces a downgrade of the equity premium that India previously commanded. To understand how this capital flight executes at scale, we have to look at passive capital flows and how thematic shifts dictate index rebalancing. This is a dynamic breakdown of the MSCI Emerging Markets Index. Over the past year, the allocation for India dropped from 19% down to 12%. According to data from M&G Investments, 2/3 of that reallocation out of India is driven entirely by AI positioning. These passive flows are tracking underlying regional earnings forecasts. Recent data compiled by Jefferies shows exactly where that future cash flow is concentrated. This comparative bar chart contrasts projected regional earnings. South Korea and Taiwan are expected to contribute 83% of all projected earnings growth for the entire Asia-Pacific region. By comparison, India is projected to contribute just 0.1% to that regional earnings growth. When looking at immediate 3-month earnings revisions, the contrast sharpens. Korea is seeing a 95% surge in positive revisions, while India is tracking a 1.1% contraction. Passive index tracking ruthlessly amplifies this exact fundamental earnings divergence. Capital drains automatically from markets that lack direct thematic catalysts. This diagram illustrates the 4 distinct stages of the global AI value chain: semiconductor chips, data center compute, frontier models, and end-user services. The current thematic capital rotation is heavily concentrated in the foundational hardware layers, specifically chip manufacturing and compute infrastructure. South Korea and Taiwan dominate semiconductor and memory chip ecosystems, allowing them to capture the massive capital expenditures required to build AI. The composition of India's equity market offers a stark contrast. Its major indices are weighted heavily toward domestic banking, financials, and legacy IT services. The Indian market has an almost total absence of publicly listed corporate champions integrated into semiconductor manufacturing or hyperscale infrastructure. During a global, capital-intensive tech infrastructure supercycle, foreign investors viewed domestic consumption narratives as a disadvantage. India's domestic-focused sectors cannot physically capture the AI-driven earnings boom. As a result, the market is systematically locked out of the current equity premium. The primary target of this market revaluation is India's $315 billion IT services sector, which has historically been the engine of the country's equity growth. This flow model shows the traditional Indian IT outsourcing structure. The business model relies on linear headcount scaling and labor arbitrage to drive billable revenue and maintain a fixed profit margin. Generative AI breaks that linear link. By automating core functions like coding, testing, and back-office maintenance, the technology poses an existential threat to the labor arbitrage model. Global clients are forcing a transition from labor-based billing to outcome-based pricing. This directly compresses the profit margin layer of these IT firms. The impact is measurable. Approximately 40,000 recent layoffs across the sector point to a structural correction rather than a temporary cyclical dip. Institutional confidence has collapsed in tandem. The Nifty IT index weight has plummeted from over 17% in early 2022 down to roughly 8%. Because the fundamental moat of labor arbitrage has been permanently compromised by AI, institutional investors are aggressively discounting the terminal value of Indian IT champions. Sector-specific vulnerabilities are only part of the equation. Broader macroeconomic headwinds are actively compounding the tech-driven capital flight. High crude oil prices are a significant headwind. Because India imports most of its oil, these high prices actively import inflation into the broader economy. This imported inflation exerts direct pressure on the currency, pushing the rupee to USD exchange rate down to record lows. The IMF has downgraded India's GDP growth forecasts to 6.5% for 2027 and 2028. This challenges the foundational narrative of India's high growth outperformance. The sole stabilizing force preventing a steeper market decline is the massive inflow from domestic institutional investors, driven primarily by retail SIPs. This has created a historic capital milestone. For the first time in over 20 years, domestic institutions now hold a larger share of Indian equities than foreign investors. However, this domestic liquidity buffer has functional limitations. It establishes a firm pricing floor, but lacks the thematic targeting required to drive multiple expansion. Domestic capital prevents a total market collapse, but it cannot insulate the economy from macroeconomic realities, nor can it replace the high beta growth previously supplied by foreign thematic capital. The data resolves the paradox. India's historically high GDP growth rate no longer automatically entitles its equity markets to a premium valuation multiple. Professional consensus has shifted. The assumption of perpetual cash flow dominance in legacy IT services is dead without durable exposure to the AI hardware supply chain. To attract global capital, India's corporate sector must execute a structural pivot, aggressively transitioning from labor-based services to capital-intensive hardware infrastructure. Professional investors are tracking specific catalysts to signal this shift. The first is future MSCI rebalancing events, alongside explicit disclosures from large asset managers regarding their thematic AI tilts. The second catalyst is the emergence of Indian-listed firms actively integrating into semiconductor supply chains. The recent fabrication partnerships between Tata and ASML serve as a primary test case. The third catalyst requires monitoring large-cap corporate capital expenditures. The market is analyzing whether domestic groups pivoting into hyperscale data center buildouts can scale quickly enough to capture global demand. Until India successfully aligns its public market composition with the physical demands of the AI infrastructure supercycle, it will remain structurally underweight in global portfolios. The era of exceptionalism is undergoing a permanent repricing.